Welcome to Thoughts on the Market. I'm Michael Zezas, Head of Public Policy Research and Municipal Strategy for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the intersection between U.S. public policy and financial markets. It's Wednesday, April 15th at 11 a.m. Eastern. The saying, "don't fight the Fed," took on a whole new meaning for bond investors last Thursday when the Federal Reserve intervened in markets in a big way. Using seed money from the U.S. Treasury, they boosted allocations to and eased eligibility requirements for some key facilities aimed at companies gaining greater access to credit. They then created two new facilities: the Mainstreet lending facility, aimed at making loans available to small and mid-sized companies, and the Municipal Liquidity facility, aimed at helping municipal issuers smooth over short-term cash flow pressures. For investors in corporate and municipal bond markets, this is a key positive. For corporates, our colleagues in credit strategy were already positive on investment-grade bonds, but now they count high-yield corporate bonds among their positive recommendations. Why? The Fed now has substantial capacity to support liquidity and credit quality in those markets. The addition of ETFs and some below investment-grade bonds to the buying programs are key supports. For municipal bonds, the Fed's actions provide two key supports to the market. First, by helping the corporate credit market, munis benefit indirectly. With mutual funds continuing to see outflows, the marginal buyer of munis is not interested in their tax benefits. Rather, they're comparing them to taxable debt like corporates. So if corporates get richer, munis may become more attractive to buyers. Second, the new Municipal Liquidity Facility, or MLF, limits some of the acute short-term credit risk that had arisen in munis. For example, pushing back the tax filing deadline to July meant that states would miss the cash infusion they normally expect from tax payments in April, at the time when costs from dealing with COVID are going higher. The MLF allows states to cash flow borrow in order to bridge this gap. Both these factors support our view that high-grade muni bonds are attractive today. Still, we'd be cautious on high-yield munis. They remain susceptible to ongoing bond fund outflows and need to further price in the credit risk associated with the recession. If the Fed extends further aid, like buying longer maturity bonds in the secondary market, we could rethink this view. Thanks for listening. For more video from Morgan Stanley, please subscribe here to our YouTube channel, or you can subscribe to Thoughts on the Market directly on Apple Podcasts or your favorite podcast platform.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.